Hello students, today we are going to learn about the business income, how to calculate this business income or the format for computing the business income. So here every individual who earn a income beyond the exemptable limit at present if their income exceeds rupees 2,50,000, then they have to file their income tax. They have to file their income tax and they have to pay the income tax to the government. So this income tax is calculated on the total income of a SSC. It is calculated on the total income of the SSC. So you know how to calculate this total income. So that is adding 5 heads of income. So namely section 15 income from salary, section 22 income from house property, section 28 business income or professional income, section 45 capital gain, section 56 income from other sources. So after adding these 5 heads of income, we are going to get a gross total income. From that, if you deduct deduction under section 80, so we will get total income. So on this total income, the income tax will be calculated. So on total income of the SSC, income tax will be calculated. So if this total income exceeds the exemptable limits, if this total income exceeds 2,50,000, then SSC has to file the income tax. They have to file the income tax and they have to pay the income tax to the government. So here, in order to calculate this gross total income, we should know what is the business income. As per section 28, we have to write if you are doing any businesses and if you are earning any income from our businesses, then we have to write the income what we earn from the business under section 28 of the Income Tax Act. So here we should know how to calculate this business income as per income tax rule, as per the section 28. So there is a rule how to calculate this business income. So I have given the format for computation of business income. So here this is a format for computing the business income. So it starts with the net profit as per profit and loss account, and for that we have to add the disallowed expenses. So why we are taking this net profit as per profit and loss account is, so here business income. So business income is nothing but it is a income what we receive from our business. If we are engaged in the buying and selling of goods and services or manufacturing the goods and services, then we will be earning any income from that business. So that income, on that income we have to pay taxes as per section 28 of Income Tax Act. So here usually every business they will prepare a trading and profit and loss account to know their financial position. They will prepare a profit and loss account to know how much profit they have earned in a particular financial year, and they will prepare a balance sheet to know the financial position. So here already every business they are preparing a profit here. So you know how this profit and loss account looks like. So this is a profit and loss account. So it shows on the debit side. On the debit side of a profit and loss account shows some of the expenses, and the credit side shows about the income. Debit side shows that it is a expenses incurred by a particular businesses. A particular business profit and loss account is a one of a business profit and loss account. So here debit side shows about the expenses incurred by that business, and credit side shows about the income received by that businesses. So here as per income tax, it says that all the expenses we can't record on the debit side of profit and loss account. We can't record all the incomes on the credit side of profit and loss account. So as per income tax, they have given some of the allowed expenses. Only few expenses should be recorded on the debit side, and only few income should be recorded on the credit side. Means here as per income tax, we have to record only the incomes or expenses which is relating to that particular business. We can't record other expenses. Maybe in profit and loss account, it might not only the business related expenses, even the personal expenses or even the capital nature expenses also may be recorded in the profit and loss account. But for income tax calculation purpose, profit and loss account of a business income should include only the business related expenses and business related incomes. So here See here, this is one of an example profit and loss account I am showing. So this is a profit and loss account of Mr. Sachin, and the debit side shows about the expenses incurred by Mr. Sachin, and the credit side shows about the income received by Mr. Sachin. So in a particular year. So here this net profit has been arrived. How you got this net profit? Net profit is arrived after adding the credit side items and deducting the debit side item. So net profit has been received. So, as per income tax, all these expenses should not be recorded on the debit side of a profit and loss account of a business, and all these incomes should not be recorded on the credit side of a profit and loss account of business. So, as per income tax, so income tax rule says that so there are some expenses should be recorded on the debit side, and only few expenses should be recorded on the credit side. So, few expenses or few incomes means the business related. Only the business related expenses we have to record on the debit side, and the business related incomes we have to record on the credit side of a profit and loss account. So here if there is a expenses, so the profit and loss account is already prepared by every businesses they will be preparing the profit and loss account every year. At the end of financial year, every year they are preparing. So the same profit and loss account is used to calculate the income tax of a assessee. So here, for income tax purpose, they are not again preparing the profit and loss account. They are not considering only the business related expenses and business related incomes, and they are not again preparing the profit and loss account. They are just adjusting the format again. So here, if there is any expenses which is not relating to business is recorded, then here the assessee will be cancelling that. So for example, we can take as a local tax on lettered property. So this is the expenses. So this is expenses incurred on a house property. It is not relating to a business. So now from this net profit, we have to delete this entry. We have to cancel the one of our expenses which is debited, which is recorded in the profit and loss account. So how to cancel? So we have got this net profit by deducting the debit side. So to cancel this, we have to add back. To cancel this, we have to add back. So that is nothing but the format shows like. So we have to take the net profit as per profit and loss. So here we have to draw 3 columns, particular and 2 amount column. So here, in order to find the business income, the starting point is we have to take net profit as per profit and loss account. So that is nothing but net profit. We have to take this value. Net profit as per profit and loss account. So to that we have to add disallowed expenses or inadmissible expenses. Disallowed expenses or inadmissible expenses. So in order to record this, we have to see the debit side of profit and loss account. So that is expenses will be recorded on the. So we are writing here disallowed expenses. Disallowed expenses means we have to see the expenses which is recorded on the debit side of profit and loss account. On the debit side, if there is any expenses which is not relating to business is recorded, then we have to cancel it. So how to cancel? If there is any expenses recorded which is not related to business, we have to cancel means we have to add back. So this net profit has been we have got this net profit by adding credit side item and deducting the debit side. So in order to cancel the debit side item, we have to add the disallowed expenses which is not relating to business. Disallowed expense is nothing but the expenses which is not relating to business should be added to the net profit. So in order to write the disallowed expenses, we have to see the debit side of profit and loss account. So I have listed some of the disallowed expenses, the expenses which is not relating to a business. I have listed some of the expenses which is not relating to a business one by one. So we'll see one by one. So the first one is household expense or personal expenses. So any personal expenses or any household related expenses it is not relating to a particular business. It is not a business expense. So that is a disallowed. If this expense, household expense is recorded here on the debit side of profit and loss account, then we have to add it back. We have to cancel. We have to delete that entry from the debit side of profit and loss account. How to delete? We can add it back to the net profit. So that is disallowed expenses should be added to the net profit. So household expense and personal expenses are not relating to business, so we have to add it back. Then any traveling expenses is used for a personal use, then it is disallowed. It is not relating to business. If it is office use, then it is allowed expenses. We can record in the debit side of profit and loss account. If it is a personal, traveling expenses used for personal use, then it is disallowed. We have to take here. Then any charity and donation. If a business has been donated, charity has given a donation to any, if a business has given a charity and donation, it is not relating to a particular business, particular manufacturing or a trading, buying and selling of that particular business. So it is relating to their personal own, for their own interest they are donating it. So it is not relating to a manufacturing of any particular goods. It is not relating to buying and selling of any particular, it is not relating to a business related activities. So it should be cancelled from a net profit. As per income tax, it should be cancelled from the debit side of net profit. So in order to cancel this disallowed or not related, the inadmissible expenses, we have to add it back. So charity and donation, if it is recorded on the debit side of profit and loss account, then we have to add it back. Then any gift or present given to relatives. So if a person, taxpayer, engaged in the business activity and he has given a gift or presents to his relatives, then it is disallowed. It is he has given a gift by his own interest. It is not relating to any of the business expenses. So it is not a business expenses, business related expenses. So it is disallowed. So we have to cancel it. To cancel, we have to add it back. So if a assessee has paid income tax or any advance tax paid, then it is disallowed. Income tax means it is a tax he has to pay on his personal income. It is not relating to a business. It is not a tax paid on business. It is a personal income. Or any, even the advance tax paid also disallowed. Wealth tax paid, property tax paid is disallowed. Means tax is paid on a wealth or a tax on property is not relating to a particular business. It is not a business related expenses, so disallowed. Then fines and penalties for breach of law. Fines and penalty for breach of law means because of his own mistake he has to pay this fines and penalty for this breach of law. So this is disallowed. Then GST paid after due date or custom duty paid after due date. So GST paid is allowed. GST paid or custom duty is paid on goods and services, means it is relating to business. GST and custom duties are a indirect tax. It is paid on goods and services. It is relating to business. So GST paid and custom duty paid is allowed, but if GST paid after the due date or any custom duty paid after due date, then it is disallowed. So we have to add. Then if any provisions, reserves or transfers to reserves are maintained, if a business has been maintained any provisions, reserves or amount or any amount transferred to reserve, then those are the not business relating to business related expenses. They have kept some of the amount from a profit. It is not a business related expenses, so it is disallowed. Then cost of asset purchased. So here only the in profit and loss account we have to record only the revenue nature expenses. So cost of asset means it is a capital in nature. So assets, if there is any purchase of asset is there, then it should not be recorded on the debit side of profit and loss account. We can record only the depreciation, but the asset value should be disallowed. Then life insurance premium. So premium policy taken on the life of a assessee. Taxpayers life insurance policy taken on the life of a assessee, and he has paid a premium amount on that life insurance policy. That is his personal life insurance policy is taken on his own life. So it is disallowed. It is not relating to a business expenses. Then any fire insurance, repairs, municipal tax or local tax paid on house property. So house property means it is these expenses are relating to house property. It should be recorded on the house property under section 22 of a house property. It is not relating to a business. It is relating to house property. It should be recorded on the section 22 of a income from house property head. So that is nothing but here under section 22 of income from house property it should be recorded, and it is not relating to a business it is not relating to a business expenses, so it should be added back, disallowed. Then proprietor's salary, so if there is any salary, owner's salary, proprietor's salary means owner's salary is not relating to business. If a business has paid a salary to his employees, then it is allowed. Salary paid to employees of a business is allowed, but proprietor, if a business owner receives salary means it is not relating to a business expenses, so it should be disallowed. Then addition to office building, addition to office building is like a capital in nature. So addition to office building means adding a extra room in the office. Maybe if you have a 4 cabin in the office, and if you add one more 5th cabin, extra room to office, then that is disallowed. Addition means it is in capital in nature, it is depreciable, so it should not be included in the debit side of profit and loss account. If you incur any rental expenses to that office building, then it is allowed. But if you add extra room to the office, addition to office building, that is not allowed business expenses. It is not relating to business. Interest on proprietor's capital, interest paid on proprietor's capital is disallowed. It is not relating to a particular business. Then help to poor college student, it is by their own interest they have helped to poor college interest. It is their personal expenses. It is not relating to a particular business expense. Then rent of business owned by assessee, if a assessee has paid a rent for the business building which is owned by the assessee. So for the being a owner of the building, if rent paid is means it is not a allowed expenses of a business, it is a disallowed, so we have to take under disallowed expenses. Then excess bad debt, if the bad debt should be recorded. If a bad debt has been recorded more in the debit side, then we have to cancel that. In order to cancel, we have to add it back, that difference, what is the extra amount recorded, that amount we have to add it back. Then excess depreciation, so if there is a depreciation recorded more in the debit side of profit and loss account, means as per accounting depreciation amount will be different, and as per income tax we have to calculate the depreciation as per section 32. So if depreciation has been recorded in the debit side of profit and loss account more, then we have to cancel it. So in order to cancel, we have to add it back, the difference, the excess depreciation. Then drawing of a proprietor, if a proprietor has used money of a business for their personal use, then that drawings is disallowed. Then reserve for future loss, any reserves are disallowed here, any reserves disallowed. Then any loss charged to profit and loss account is not relating to business, so it is disallowed. Then any non-business expenses, any non-business means which is a expenses which is not relating to business is disallowed. Then cash payment of above 10,000, so if a business makes at a time, if they makes cash payment of 10,000 and above for any purchases from any supplier, if they purchases any material and if they make a cash payment of 10,000 and above, then the entire amount is disallowed. If it is 15,000, the 15,000 is disallowed. If it is 11,000 is disallowed. So exceeding 10,000 means you should not take the difference, the entire amount is disallowed. Here in bracket write entire amount is disallowed, entire amount is disallowed. Next one is sales tax or excise duty paid after due date. So the actually the sales tax and excise duty is allowed. So sales tax is nothing but the tax imposed on sale of goods, and excise duty is nothing but the tax imposed on the manufacture of goods. Now at present these taxes are not there, it is a GST has been renamed. So if these sales tax, excise duty or GST paid or custom duty paid after due date means it is disallowed. If they have paid before due date, then it is allowed. But sales tax, excise duty, custom duty or GST, if it is paid after due date, disallowed. But income tax, wealth tax are disallowed. Okay. But these allowed taxes, if it is paid after due date, also disallowed. Then subscription to NSC, if a taxpayer invest in the national savings certificate, then that also disallowed. It is their personal expenses, it is not relating to a particular business expense. Then Loss due to embezzlement after office hour is disallowed. If it is loss due to embezzlement means if any employee stealen or theft by employee or stealen or robbing by the employee or any misappropriation by the employee during the office hour is allowed, but after office hour is disallowed. Okay, during office hour is allowed, after office hour is disallowed. Then loss on sale of assets used for personal use. Loss of sale of asset is disallowed. Then preliminary expenses written off allowed only in 5 installment, so remaining is disallowed. Salary to personal servant, so it is personal servant is salary paid to personal servant is disallowed. If it is office servant, it is allowed. Personal servant disallowed. Any outstanding expenses are disallowed. Any outstanding expenses are disallowed. Means here income tax is levied on the already incurred. Whatever the outstanding expenses are there, that is not taken for the debit side of profit and loss account. Then medical insurance of family means it is a personal, so medical insurance policy taken on the family members disallowed. It is not relating to business. Then gratuity paid to an employee as a special case, so gratuity paid to employees are allowed, but as a special case if gratuity paid, then it is disallowed. Then legal expenses incurred to defend a criminal liability. So criminal liability means it's their own fault. In order to protect that criminal liability, if any legal expenses incurred means that is disallowed. It is not relating to business. It is a personal expenses. Then penalty paid for illegal import of goods. So if a assessee illegally import the goods and penalty pays means it is a illegal. By his own interest he has been imported. So it is his fault and he has to pay a penalty. It is not relating to a business. Then litigation expenses incurred for curing any defect in the title of business. So this is also a defect incurred because of their own fault. So any litigation means any legal expenses incurred for this is by their own mistake. So it is disallowed. Legal expenses incurred for protecting the title of business is allowed, but for protecting the defect in the title of business is disallowed. Okay, but legal expenses incurred to protect the title of business is allowed. If there is any defect in it means it's their own mistake. It is a personal expenses not relating to business expenses, so it is disallowed. Next one is undervaluation of closing stock and overvaluation of opening stock. So undervaluation of closing stock and overvaluation of opening stock should be added, and overvaluation of closing stock and undervaluation of opening stock should be deducted. So why it is added and deducted means usually we will prepare a trading and profit and loss account. So in the trading account we are recording this opening stock as well as closing stock. So on the debit side we are recording the opening stock to opening stock. So after recording all the items from the credit side and recording the debit side item, we will get a gross profit here. So here we have recorded opening stock. We'll take the example of overvaluation. Opening stock overvalued means we have recorded opening stock more here. Actual opening stock is less, but we have recorded more. So how you calculate the gross profit? Totaling the credit side, deducting the more recorded opening stock. So we will get, it means we are getting the gross profit less. When opening stock is recorded more, we are going to get a gross profit less, and when gross profit is less, when that time net profit also shows less. So because of overvaluation of opening stock, because we have recorded more opening stock here, so because of that more amount of opening stock, our profit shows less. So we have to show our exact profit by cancelling this over recorded opening stock. How to cancel? It is a means we have deducted more opening stock to arrive at gross profit. We have deducted the more, means here we have deducted more opening stock in order to find the gross profit. Okay, now in order to cancel this, we have to add the overvaluation of opening stock, adding the overvaluation of opening stock. So if opening stock has been recorded less, assume as opening stock has been recorded less. In this case, we are totaling the credit side and we have recorded less opening stock. When we recorded less opening stock means our profit shows more. When we recorded less opening stock means our profit shows more. So we have to record actual opening stock. So we have to record still more opening stock here. It is actually recorded less. So we have to record still more opening stock. In order to record, what we have to do? We have to deduct the undervalued opening stock. So that's why undervaluation of opening stock is deducted from a net profit. From a net profit we have to deduct. Similarly, we have to do the treatment for closing stock. Similarly we'll see for the closing stock. So undervaluation of closing stock should be added, overvaluation of closing stock should be deducted. So we'll see about the closing stock. So in the case of closing stock, here we'll assume we have recorded more closing stock, overvaluation of closing stock. So we have added more closing stock here. So because of that, this total gets more. So because of that, the profit also shows high. Clear? Because of that, our profit shows more, isn't it? Because of closing stock added more here. We are adding the credit side. So in the credit side we have added more. Because of that, our profit total gets more and our profit also shows more. So now what we have to do, in order to find the actual profit, we have added more closing stock here. Now we have to cancel it, means we have to deduct the overvaluation of closing stock. So overvaluation of closing stock, see here, overvaluation of closing stock should be deducted. So similarly, undervaluation of closing stock. So closing stock has been recorded less, means added. Here we are adding. So this here to the net profit. Closing stock recorded less, undervaluation of closing stock. So when closing stock recorded less, this total shows less. When this total shows less, our profit shows less. Our profit shows less, isn't it? So in order to get an exact profit, what we have to do, in order to get so we have to record it. We have to add the undervaluation of closing stock. Undervaluation of closing stock should be added. So undervaluation of closing stock should be added. So I think you understood this. So overvaluation. So remember the point here. So you can easily identify like overvaluation of opening stock. Because of that, profit shows more, so we have to add it. Undervaluation of opening stock means because of that, profit shows less, we have to deduct it. Then overvaluation of closing stock, profit shows more, we have to deduct it. Undervaluation of closing stock, profit shows less, we have to add it. So that is the treatment for overvaluation and undervaluation. So after that, all adding the items, we have to total to the net profit. Next we have to take income to be treated separately, is nothing but disallowed incomes. So to record the income to be treated separately, we have to see the credit side of profit and loss account. So see here, credit side of profit and loss account. So on the credit side, if there is any incomes which is not relating to business is recorded, then we have to cancel it. So it means that here there might be some of the incomes which is not relating to business is added. Now because of that value, the net profit will be shows more, because it is added here. Because of that, net profit shows more. So in order to cancel it, we have to deduct from the net profit. So that's what we have to do here. Disallowed incomes we have to deduct, disallowed expense we have to add. Disallowed incomes, the income which is not relating to a business should be deducted. So the income which is not relating to business is known as disallowed income. So that income should not be recorded in the section 28 of business income. It should be treated separately. Those income should be treated separately. So I have listed out some of the income which is asked in the questions. Rent received from a house property. So to record this, we have to see the credit side of profit and loss account. So the first one is rent received from house property. So house property, rental income from house property is a house property income. It is not relating to a business income. It should be recorded in the house property header. So here we have to cancel. So to cancel it, we have to deduct from a net profit. Next, capital gain. Income from a gain is nothing but the income arised from a sale of capital asset. It is not relating to a business. It is relating to a section 45 of a capital gain head. So it is not relating to a business income. It is relating to section 45 of capital gain. So it is not taken in the net profit of a business income. So it should be cancelled. To cancel that, we have to deduct from a net profit. Then income from other source. So income from other source should be taken under section 56. It should not be recorded in the business income. It is not taken as a business income and it should be cancelled. To cancel, we have to deduct from a net profit. Then interest on fixed deposit, refund of income tax, interest on refund of income tax. These are the income from other sources. It is not relating to business income. So we have to cancel it. It is taken as a other source income and it is not a business income. So it should not be taken on the debit side of profit and it should not be taken on the credit side of profit and loss account. So that's why we have to deduct it. Then interest on government security, winning from lottery, horse races, interest on government securities or debentures. These are the income from other source. It is not a business income, should be taken separately. Then profit from sale of shares is a taxable under the head capital gain. It is not a income from a business. Then dividend income. Dividend income is not relating to a business. It is their personal dividend income. They have to tax under other source head. It is not relating to business. Then interest on POSB, post office saving bank account, also it is not relating to business. Particular business, it is not relating to a particular business related income, so it is not taken here. Then not taken on the credit side of profit and loss account means we have to delete it. To delete that, we have to deduct from a net profit. Then agricultural income is disallowed. Share of income from a firm, profit from smuggling, profit from sale of asset, overvaluation of closing stock, undervaluation of opening stock. These are the disallowed income and should be deducted from a net profit. So after adding all these items, we will get one value. So we have to deduct from a net profit. Then we have to deduct the allowable. So allowable expenses not allowed so far means there are some allowable expenses should be recorded. There are some allowable expenses should be recorded on the debit side of profit and loss account, but they have not allowed so far means they have not recorded on the debit side. So we have to record. So those expenses will be shown on the adjustment or additional information part of a question. So in the question, in the additional information adjustment part, so the first part, disallowed expense, we have to see the debit side. Disallowed income, we have to see the credit side of profit and loss account. And for the allowable expenses not allowed so far, we have to see the additional information or adjustment. So if there is any expenses which is relating to business and not recorded here, then we have to record. To record, we have to deduct from a net profit. To recording means what? Recording to net profit means what? We are total adding. So these items is deducted to calculate this net profit. So if you want to record any item, then we have to deduct that item from a net profit. So that's why allowable expenses which is not recorded so far will be available in the adjustment and we have to deduct it. So example, we can take a depreciation allowable as per section 32 or any allowable expenses not debited to profit and loss. If they give in the question, then we have to deduct it. So next one is bad debt recovered and disallowed earlier. So bad debt recovered and disallowed earlier should be deducted. Means here, for example, 10,000, we can take 10,000 bad debt allowed in the previous year. Means in the previous year profit and loss account, business has thought that the bad debt of 10,000 value, they are not going to, the debt of 10,000 value, they are not going to get it back. So it becomes bad debt. So in the previous year, they have taken as a bad debt and they have recorded on the debit side of profit and loss account. Because of that bad debt, they have shown the profit less and they have paid a less income tax in the previous year. But this year that bad debt has been recovered. Means they have they expected that debt is they are not going to get a debt back, but in this year that debt has been recovered. So since that debt has been recovered. Now they have to pay the tax on that bad debt recovered, so it should be deducted. Bad debt recovered disallowed earlier should be deducted here, so we will get business income. So this business income should be written on the section 28 of business income. Under the head business income, the final answer we have to take. So it is not same as a net profit, so we are going to get a different answer as per income tax rule if you apply this calculation. So that is for the net profit, that is for the net profit we have to add disallowed expenses, and we have to deduct the disallowed incomes, that is nothing but income to be treated separately, and we have to deduct the allowable expenses not allowed so far, and bad debt recovered disallowed earlier. Then we will arrive at business income. So on this business income, this business income should be written under the, so this business income should be written on the section 28 of under the head business income. So the professional income is different, so this calculation will be there in the next concept. So this is about the business income, calculation of business income.